Hi, Chris Maloof with Cross Country Financial here. Boy, it's been a crazy few weeks in the markets lately. The big R word, recession, is being used quite a bit, but are we heading in that direction? Today we're going to give you a couple things to watch out for. Stick around. Not all recessions are created equal. Previous downturns in the U.S. were prompted by various shocks, with the most recent recession started by health and government-induced shutdowns. Other recessions started in the corporate sector, whereas some started from commodity shocks. The next one could start from geopolitical tensions. Nonetheless, we think the current business and consumer environments are safe from near-term recession risks. But not all recessions are created equal. Recessions are sometimes difficult to describe, let alone predict. Definitions vary widely. To make matters worse, some coin their mixed forecast as a growth recession. Some simply describe a recession as 2 consecutive quarters of negative economic growth, which is clearly not true because the 2001 recession was shorter. Growth in the first quarter of 2001 declined by 1.3% annualized, but between strong quarters, both grew above 2%. The National Bureau of Economic Research is the official arbiter of recessions, and their definitions is not much better. As they say, a recession is a significant decline in economic activity spread across the economy that lasts more than a few months. That's pretty vague. The NBER specifically looks at economic indicators such as production and employment. Because the definitions can be elusive and ambiguous, we think it behooves investors to focus on the overall trajectory and not economic environment for both businesses and households. In my line of work, we hear this one a lot, but this time is different. Or is it? As we emphasized before, each recession has different causes and different impacts, but one thing that is not different is the required analysis. Whatever the circumstances, investors should look at multiple signals, not just the infamous and often misused inverted yield curve indicator. Our base case is the domestic economy will weather through this current storm of elevated prices, geopolitical risks, and clogged supply chains. Serious risks remain, but we think businesses and consumer metrics support our base case thesis in the U.S. will not fall into recession this year. One reason why? Consumers are much less levered this time around. After the great financial crisis, consumers started deleveraging. Both the debt service ratio and the broader financial obligations ratio gradually declined and remained steady until the emergence of COVID-19. Government pandemic assistance programs, including stimulus and forbearance periods, added volatility to consumers' financial obligations. But if consumers are able to keep relatively low debt levels, we think the consumer can successfully navigate a period of rising borrowing costs without squelching spending. Another reason, checkable deposits are at historic levels. High savings will help consumers navigate the current inflationary period. Given the uncertainty of the pandemic and generous stimulus measures, deposits grew to roughly $3 trillion above normal levels. That's trillion with a T. During the crisis, when the Federal Reserve aggressively cut rates and individuals were highly risk adverse, the cost of holding checkable deposits was low, so individuals tended to increase savings, thereby adding to bank deposits. Aggregate savings were also bolstered by higher income households who normally spend a larger percentage of discretionary income on services like travel experiences, but were shut down during the pandemic. Accumulated savings provide a cushion for some consumers during this period of high prices and economic uncertainty. Labor market gives power to the people. Employment rebounded from the lows of April 2020, but soon after the beginning of 2021, the rate of job creation slowed. The tight labor market is ripe for the 1.5 million former workers to return on their own terms. Such a high inflationary environment could convince some of these lost workers to return. As long as the economy is approaching full employment, the Fed will focus on the mandate for price stability. Our base case scenario includes a cooling of both inflation and the job market, which may allow the Fed to pause the rate hikes toward the end of the year, limiting risks of over-tightening. In many previous cycles, the Fed was accused of over-tightening and pushing the economy into a hard landing, which is a scenario where unemployment rises and economic growth contracts. Firms are taking advantage of pricing power. Consumers are likely in a safe place for the current environment, but what about businesses? Have you slowed down your Starbucks consumption? The National Federation of Independent Businesses reports that small businesses are adjusting to a variety of current headwinds, such as a tight labor market and high quit rates and clogged supply chains pushing up raw material costs. As of March, roughly 50% of small businesses in the U.S. raise compensation to attract and retain workers, according to the NFIB. In the same month, over 70% of firms raised prices to cover increased costs. Firms with the ability to pass along cost increases will be able to protect profit margins as labor and material costs increase. Another indicator, purchasing manager surveys show expansion. Managers in both services and manufacturing anticipate a slowdown in business, yet still expect growth in spite of the headwinds from commodity markets and tight labor markets. In fact, both indexes are above 55, values above 50 indicating expansion. If firms are able to recalibrate running their business, we expect a rebound in growth the latter half of this year, even though the first half might be sluggish. As a conclusion, not all recessions are the same. Risks remain. The Fed could lose sight of its dual mandate, or supply chains remain clogged from Eastern European wars and Asian lockdowns. Inflation could not cool as consumers pivot back from goods-centric spending, that's cars and washing machines, to services spending, more like hotels and airplane tickets. In spite of all these risks, the metrics above suggest that the economy could escape a recession in the near term, with potential for nearly 3% growth this year. On balance, we think the economy is steady enough to handle the current tightening cycle, even if the Fed is coming late with its hawkish tones. If you found this information beneficial, hit that subscribe button, invest early and often, and we'll see you next week.